WebVan, the 1.2B grocery delivery giant that died in 2001. Picture this. It's 1999, and while most people are still figuring out how to use dial-up internet, there's a company in San Francisco promising to deliver your groceries in 30 minutes. Fresh produce, dairy, meat, household essentials, all ordered online and delivered faster than you could drive to the store yourself. This wasn't some small startup operating out of a garage. This was WebVan, a company that raised over $1 billion and built a logistics network that would make Amazon jealous. In fact, Jeff Bezos himself was reportedly nervous about WebVan's potential to dominate online retail. But here's the kicker. While Amazon was still primarily selling books and losing money on every sale, WebVan was already solving the holy grail of e-commerce, the last-mile delivery problem for everyday essentials. They had the vision, the funding, and the technology to revolutionize how Americans shop for food. So why did this dot-com darling, which at its peak was valued at over $4 billion, completely vanish in July 2001, taking with it the dreams of 30-minute grocery delivery that wouldn't resurface until DoorDash and Instacart arrived nearly 2 decades later? The story begins with Louis Borders, yes, that Borders, co-founder of the bookstore chain that would later become Amazon's biggest rival before its own spectacular collapse. In 1996, Borders was riding high on his retail success and became obsessed with a new challenge. Could you apply sophisticated logistics and technology to make grocery delivery not just possible, but profitable? Unlike other entrepreneurs who might start small and test the waters, Borders went full throttle from day one. He spent 2 years developing what he called a revolutionary warehouse management system, complete with proprietary software that could optimize delivery routes in real time and predict customer demand with machine learning algorithms that were incredibly advanced for their time. The system was so complex that it required custom-built warehouses spanning 330,000 square feet each, equipped with automated conveyor belts, robotics, and temperature-controlled zones for different product categories. These weren't just warehouses, they were technological marvels that cost $30 million each to build, and Borders planned to construct at least 26 of them across major metropolitan areas. When WebVan officially launched in June 1999, the company's timing seemed perfect. The dot-com boom was in full swing, consumers were just beginning to embrace online shopping, and traditional grocery stores seemed ripe for disruption with their narrow aisles, long checkout lines, and limited hours. WebVan's service was genuinely impressive. Customers could browse over 10,000 products on a user-friendly website, place orders until midnight, and choose delivery windows as narrow as 30 minutes. The delivery fleet consisted of distinctive trucks equipped with multiple temperature zones, allowing drivers to transport frozen foods, fresh produce, and household items in optimal conditions. In San Francisco, their initial market, WebVan offered delivery 7 days a week from 6 a.m. to 10 p.m., covering nearly every neighborhood within their service area. The company's fulfillment centers were engineering masterpieces, capable of processing up to 8,000 orders per day with accuracy rates exceeding 99%. Workers didn't walk through aisles picking items. Instead, the products came to them via automated systems, dramatically reducing the time needed to prepare each order. The investor appetite for WebVan seemed insatiable, and the numbers were staggering even by dot-com standards. The company's initial public offering in November 1999 raised $375 million, giving WebVan a market capitalization of over $4 billion, despite having revenue of just $178,000 in the third quarter of that year. Benchmark Capital, Sequoia Capital, CBS, and Goldman Sachs were among the high-profile investors betting big on Borders' vision. But the real money came from debt financing and additional equity raises that pushed WebVan's total funding to over $1.2 billion by 2000. This massive war chest enabled the company to expand aggressively, launching operations in Atlanta, Chicago, Los Angeles, Orange County, Portland, Sacramento, San Diego, and Seattle within 18 months. Each new market required the construction of those expensive fulfillment centers, the hiring of hundreds of employees, and massive marketing campaigns to build customer awareness. WebVan was spending money faster than almost any company in history, burning through approximately $50 million per quarter by 2000, but investors remained confident that scale would eventually lead to profitability. The fundamental problem with WebVan's business model became apparent almost immediately, but the company's leadership remained convinced they could engineer their way out of trouble. Grocery retail operates on incredibly thin margins, typically between 1 and 3%, which means there's almost no room for error in operational efficiency. WebVan was charging customers just $3.95 for delivery, a fee that didn't even cover the cost of gas for their trucks, let alone driver wages, vehicle maintenance, and insurance. The company's internal analysis showed they needed each customer to place orders worth at least $75 to break even on delivery costs, but the average order value hovered around $53. Even worse, customer acquisition costs were astronomical, sometimes exceeding $100 per customer through expensive television and radio advertising campaigns. While WebVan's technology was impressive, it couldn't overcome basic economic realities. Delivering relatively small orders to individual homes is inherently expensive, and customers weren't willing to pay the true cost of that convenience. The operational challenges went far beyond simple math problems. WebVan's sophisticated technology systems, while innovative, were also incredibly complex and prone to failures that could cascade throughout the entire network. When demand spiked unexpectedly, which happened frequently, the automated warehouses couldn't adapt quickly enough, leading to stockouts and missed delivery windows. The company discovered that grocery shopping behavior was far more unpredictable than boarders had anticipated. Customers might order heavy items like cat litter and soda one week, then switch to just produce and dairy the next, making it nearly impossible to optimize truck routes and warehouse layouts. The 30-minute delivery promise, which was WebVan's key differentiator, became a logistical nightmare during peak hours when traffic was heavy and multiple customers in the same building might place orders at different times. Drivers often found themselves making multiple trips to the same apartment complex, destroying any hope of route efficiency. The company also struggled with product quality issues. Unlike customers shopping in person who could examine produce and check expiration dates, WebVan's workers had to make those judgments, leading to complaints about bruised fruit, expired dairy products, and wrong brands. Perhaps most damaging to WebVan's long-term prospects was their decision to expand rapidly rather than perfect their operations in existing markets. While the company was still losing money on every single delivery in San Francisco, they were simultaneously building expensive fulfillment centers in 8 other cities. This expansion strategy made sense from a venture capital perspective, where capturing market share quickly was seen as essential to fending off competitors, but it multiplied WebVan's operational challenges exponentially. Each new market had different customer preferences, traffic patterns, and competitive dynamics that required months of fine-tuning. The company found that wealthy customers in Orange County had completely different shopping habits than young professionals in Seattle, but WebVan's systems were designed for standardization, not customization. Instead of achieving the economies of scale that boarders had promised, the rapid expansion created diseconomies of scale where each additional market made the overall operation less efficient and more expensive to manage. The competitive landscape also shifted dramatically during WebVan's brief existence, creating threats from directions the company hadn't anticipated. Traditional grocery chains like Safeway and Kroger began experimenting with their own delivery services, leveraging their existing store networks and supplier relationships to offer competitive services without building expensive fulfillment centers. Amazon, meanwhile, was quietly expanding beyond books and had the patient capital to sustain losses while building their logistics capabilities. Even more dangerous were smaller, local competitors who could offer personalized service and lower overhead costs by using existing grocery stores as fulfillment centers instead of building custom facilities. Peapod, WebVan's main national competitor, was taking a more conservative approach, partnering with established grocery chains and focusing on profitability over growth. When the dot-com bubble began to deflate in March 2000, investors suddenly became much more interested in companies that had a clear path to profitability rather than those promising massive scale and future dominance. The beginning of the end came in early 2001 when WebVan's financial situation became untenable, and the company's leadership made a series of desperate moves that only accelerated their demise. In February, WebVan announced they were acquiring Home Grocer, their Seattle-based competitor, in a deal worth $1.2 billion in stock. This merger was supposed to create synergies and reduce competition, but instead it added Home Grocer's losses to WebVan's already massive cash burn rate. The combined company was losing approximately $525,000 per day, with no realistic prospect of reaching profitability in the foreseeable future. By this point, the broader technology sector was in free fall, making it impossible to raise additional capital from public markets or venture investors who were focused on preserving their existing investments rather than funding new growth initiatives. WebVan's management began closing operations in individual markets, starting with Atlanta and Dallas in April 2001. But these closures provided only temporary financial relief while destroying the company's credibility with remaining customers and employees. The final collapse happened with shocking speed, even by dot-com crash standards. On July 9, 2001, WebVan announced they were ceasing all operations immediately and laying off their remaining 2,000 employees. The company had burned through virtually all of their $1.2 billion in funding in less than 3 years, making it one of the most expensive failures in business history. Customers who had placed orders the night before found their deliveries canceled and their money tied up in bankruptcy proceedings. The sophisticated fulfillment centers that had cost millions to build were sold for pennies on the dollar to companies like Amazon, who quietly acquired some of WebVan's technology and logistics expertise. Louis Borders, who had been hailed as a visionary just 2 years earlier, became a cautionary tale about the dangers of prioritizing growth over profitability. The entire online grocery delivery sector was so damaged by WebVan's failure that it would take nearly 15 years before companies like Instacart and Amazon Fresh could convince consumers and investors to give the model another chance. WebVan's story remains one of the most spectacular examples of how even the most innovative technology and seemingly unlimited funding cannot overcome flawed business fundamentals and the basic economics of retail operations.